The stock market is up early on Thursday, despite some pretty weak earnings reports from a couple of companies, but the speculation continues to be around tariffs. Are there tariff deals that are going to be made in the next few days or the next few weeks? That's what the market is hoping for, or at least an easing of some of these tensions that we've had. Now, what's the reality here? I don't think anybody really knows what the reality is, but the market is a forward-looking mechanism. So investors are buying into the possibility that these tariffs are going to come down, especially with India and Japan, which could be some of the first to sign trade deals. China, it looks like may take a little bit longer, may actually be more impactful. But let's look at what's going on with the markets. You can see the Dow Jones up 0.6%. I'm recording this a little after 11 o'clock Eastern time. S&P 500 up 1.4%. And the Nasdaq is outpacing all of them, up 1.9% for the day. Now, the biggest news is that Treasury Secretary Scott Bessent, who seems to be the person that the market is turning to the most, is saying that a deal with India is probably the most likely. Some of his comments earlier this week indicated that he sees that some of these trade tensions are going to be coming down with China. It's unsustainable to have the high level of tariffs that you have on both sides with China. And we're probably going to see that spill over into revenue earnings and even the availability of product. That came out of a meeting with the CEO of Target and Walmart and the president earlier this week as well. So the reality of the economic impact of these tariffs seems to be making its way to the White House a little bit late. Right now, the market is buying into the fact that this isn't going to drive us into a recession or a potential depression in the US at least. But that's the only real economic news we got today. I think what's ultimately more important is earnings. I'm going to go through a couple of those earnings reports quickly. And then the big earnings report is going to be Alphabet, parent company of Google, which reports after the market closes today on Thursday. My name is Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for online content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. One of the first earnings reports that I thought was interesting this morning was Comcast. Comcast has seemed to be this really diversified company in media that has a lot going for it. I kind of see it as the opposite. A lot of their businesses are in decline, but let's go through some of those numbers because it's really starting to show in their earnings. You can see that revenue was down 0.6% in the quarter. Adjusted EBITDA is up only 1.9%, and adjusted earnings per share up 4.5%. But you start digging into these numbers, and the numbers are pretty bad for Comcast. You can see the headline number here is that total connected and platform customer relationships, that's domestic, international, and business connections with customers, down 228,000 in just the first quarter. The one that I think is the most surprising is that broadband customers are in decline as well. We know that people are cutting the cord for cable. That's not a real surprise, and that's what you see on the bottom there. Video customers, that was down 427,000 in the quarter, now just 12.1 million. But where you would expect to see strength and the ability to potentially bundle for Comcast is going to be in the broadband business. But that's also in decline, lost 199,000 customers in the quarter. And that's really showing that their bundle is starting to fall apart. You used to be able to bundle phone with video and broadband. Now, if you're canceling cable, maybe you're looking at alternatives. You're looking at 5G wireless. You're looking at fiber wireless. So obviously, some of those customers who are canceling their video are also canceling broadband. The other results that I think are really terrible and just show what a tough position Comcast is in today is what's going on with Peacock. You can see that media results included $1.2 billion in revenue from Peacock, but also included $215 million in adjusted EBITDA loss. Now, I've talked a lot on this channel about how the smiling curve works, how on the internet, you need to be either the biggest player or one of the smallest player, an individual creator like me. But the biggest players in streaming are clearly YouTube, Netflix, and then kind of third place player is Disney. And Peacock and Comcast is going to be fourth, fifth, maybe sixth in line. There is just not an ability to create enough scale in that business, have any sort of pricing power. And think about who are you going to cancel first if you're going to cancel a streaming service. Peacock is probably towards the top of the list if you are a subscriber at all. So I think this is one of those businesses that's just in a really tough position. It doesn't look like it's going to be getting any better anytime soon. Definitely not a stock that I'm buying. And shares are down about 5% as I'm recording.
Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now.
The other big one was Chipotle. Chipotle announced a 6.4% increase in revenue, but most of that came from just adding more restaurants to their fleet. The comparable same-store sales was actually down 0.4%. And this is one of the weaker quarters that we've seen recently from Chipotle. This is like one of those companies that's been able to raise prices, increase the number of people going through their restaurants, as a lot of other restaurants have struggled, but they may be hitting a ceiling with how much they can push on both price and more volume. You can see that the number of transactions was down 2.3% in the quarter, and the average check was actually down 1.9%. So customers are pulling back a little bit. I think that's something we're seeing broadly. When you start to see it at a company like Chipotle, should raise those alarm bells for you as an investor. Pepsi is another big conglomerate company that you would expect is going to be kind of recession proof. They make a lot of products that people are just going to buy it no matter what's going on with the economy. But their pricing power and their revenue has really struggled And this is one of those things that I think investors need to understand, that the businesses that were dominating supply, like Pepsi, where they had control over space on store shelves, where their business is predicated on things like TV advertising and brand building. Those businesses have really been hurt over the past decade because of the rise of the internet and some of these smaller players that have taken some of that shelf space. So it's no surprise that Pepsi is not in the strong position that it used to be, but it's really starting to hit their income statement, and their comments about tariffs should be noted as well. You can see the top line numbers. Revenue is down 1.8% in the quarter, and earnings per share change was down 10%. So you think of this as a value stock. You think of this as a kind of a stalwart company. But if you're not getting Pepsi at a no-brainer price where you're going to be able to generate an easy return, I think this is one of those stocks to just avoid. And another reason is their comments based on tariffs. You can see in this highlighted section that given higher supply chain costs related to tariffs and elevated macroeconomic volatility, and most of that volatility is caused by tariffs, they now expect earnings per share to be about flat from a year earlier. They were expecting mid-single digit growth. So shares of Pepsi trading at 21 times trailing earnings. That's actually a pretty expensive price for a company that's not growing, actually shrinking on the top line, and at best is probably going to report about flat earnings on an earnings per share basis. So again, the power that Pepsi used to have in the market just doesn't exist anymore, and we're seeing that in their earnings and in their movement in their share price. The other one that caught my eye today is American Airlines. Not very strong results, and that's what you would expect given what we know from a macroeconomic backdrop. You can see the total revenue was down 0.2% in the quarter. The company also swung to an operating loss. So that was one of the surprising things in their numbers. Their net loss, $437 million. When you look at their second quarter guidance, you're seeing more weakness. Available seat miles, ASM, is expected to be up 2 to 4%, but the cost per average seat mile, CASM, is going to increase 3 to 5%. Total revenue at the same time. So you would expect that you're going to be growing if you're increasing your capacity and your costs are going up. You're going to have to increase your revenue pretty significantly, between 3 to 5%, just to generate the same amount of earnings. But they're expecting revenue to be negative 2% to positive 1%. So that midpoint expecting a little bit of a decline in revenue. So that's showing the weakness that we see in the airline industry. I would expect that to continue throughout the rest of the year. And the common theme across all of these earnings reports is that the consumer is not particularly strong right now. Now, does that mean that we're in a recession or that we're definitely going into a recession? I don't necessarily think that yet. Very possible that we are, but it does show the sensitivity and why investors are so concerned about tariffs. If consumers are already stretched, they're starting to pull back on things like travel, what they're spending at restaurants like Chipotle, then that means that higher costs from tariffs, if you're having to spend twice as much on a t-shirt or a pair of shoes, that's going to have a huge impact on what customers are spending elsewhere. So something to add to your analysis. Let me know what you think about what's going on with the market and with earnings. What do you think about these earnings report? And then keep an eye on Alphabet's earnings after the market closes. This is one of the big tech companies that everybody's looking at because they have a huge presence in artificial intelligence, but they're also an advertising business. Remember, search is actually an advertising business. So our advertisers starting to pull back because they're starting to see consumers pull back. That could be one of those indicators that's going to be much more important than you might think. I will be covering that earnings report here on Asymmetric Investing tomorrow. So subscribe and check that out. Let me know what comments or questions you have in the comment section below. Thanks for watching, everybody. See you here next time.